Hey everyone, welcome to The Fiscal Philosopher. If you're new to the channel, please like and subscribe. We make videos about financial as well as economic concepts and give you tips on how to make the most of your money. Today we got a super interesting video about who can benefit from this infinite banking strategy. I'm sure you've seen it going around TikTok and Instagram. Let's get right into it. Since dividends from mutual insurance plans represent a return of an intentional overcharge, they are not subject to taxation. So this is the IRS Tax Code, which applies to permanent life insurance policies. They are the key element of this strategy called infinite banking. As I mentioned before, I'm sure you've seen it going around TikTok and Instagram, but this idea goes by a bunch of other names like family banking, private banking, but it's all the same concept popularized by a guy named Nelson Nash, which is where you pay into a permanent insurance policy and then you borrow against its cash value in the future. But like with any investment, the client's wants and needs should come before any discussion of financial products or strategies. I mean, because almost every financial product has a place. I'm a big believer in this. But what one person needs may be the exact opposite of what another person actually needs in the future. So before making a recommendation, you've got to examine a bunch of things, like their assets, their cash flow, their income stability, as well as their appetite for risk. While I'm convinced that this infinite banking strategy is a good method for some people, there are so many circumstances where it isn't. So let's imagine for a second that your average American, they live paycheck to paycheck, they have no emergency fund, definitely not one big enough to cover 3 months of expenses, and they don't use their tax advantage savings plan. So most likely if these people came to my office, I would say they would benefit from having a budget and a plan for saving money before they lock themselves into an unbreakable contract that they must keep paying for. Because let's say they don't have enough money saved to last for 3 months and their car breaks down, or some other thing that they have to pay for. So they are at risk of having to pay huge surrender fees on these policies if they need to use their savings and the cash value hasn't accrued. Because like one of the most important things you have to consider when figuring out how risky something is how much you can stand to lose in total from this thing. So you can say that there are some pros and cons of using these policies as like retirement savings. You can even use them as investments with the cash value tied to a stock index. But even so, the liquidity of something like an IRA is so much more stable. Because even if you get taxed on the withdrawals, it's still less. And another part of this risk equation is the ability to keep paying this premium. So let's say, for example, you do have 3 months of emergency savings, but your job is unstable. You need to be able to keep paying the premium. The last thing that you want in your life when you lose your job is a plan that forces you to save money, but if you stop paying into it, you lose everything. Even if you stop making payments into your retirement accounts like your IRA, the balance will still be there and you can pull them out even if you have to pay the penalty. Now let's say you have all of these things in place and you're looking to buy your first home. So if you're banking with an infinite policy, you can only borrow against what you actually put in, and you would have to still pay interest on that, albeit you would be refunded some of it. Whereas I could walk into any bank where I haven't put any money down and buy a house with 3.5% down as long as I have good credit. That's a 28.5 times multiple on your investment. I don't think most people can use these infinite banking products. But let's say you're not too old, you're not too poor, you got a lot of money saved up, you maxed out your 401k, your IRA, you got a stable income for the foreseeable future. So one thing that might be super important to you is making sure that the future of your family is actually taken care of. You know that if you stay alive, you're going to be able to take care of them. You're going to make money, you're going to send them to school. But if you die, your savings are probably going to be gone in a few years. You're still in the early stages of building up, so you might actually care a lot about this death benefit. And it's crazy that we've been talking about life insurance for this long, but we're just now getting to talking about the death benefit. Now, what if you could get a refund on the cost of the premiums for the death benefit? And you can even keep assets safe from creditors, lawsuits, divorces, like the other downside of life. Because of how these policies work in a mutual insurance company, at the end of the year, they figure out how much money came in from premiums, policy loans, and other investments that they made, and how much money they sent out in claims, including like the cost of insurance, running the company, etc. So then they give each policyholder a refund because they paid too much for that amount of insurance. But it happens to be these companies, they're the bedrock of society, pretty much. They're pretty good at making money. So there's a chance that these dividends will be worth more than what you put in. So if you let this happen, so all of the tax benefits of a policy like this, like the tax-free growth in the cash value account, are going to be gone forever. It's something called a MEC. There are, however, other ways to get around it that are kind of outside the scope of this video. But another cool way that you could use this is saving for college. Because the insurance company actually owns the asset, it's not going to be counted in your net worth for things like financial aid. So you could qualify for financial aid and then borrow against this policy to pay for college. So these are a few situations where permanent insurance could be a great solution for people and even be used for infinite banking. There are always those advisors, though, those people that say that this policy, this product, it can work for anyone. And in my opinion, like, that idea could not be farther from the truth. Like, first of all, let's not forget that these are life insurance policies. You have to be in good health to qualify. If you aren't, you're going to have to pay super high premiums for that cost of insurance. And even so, like, let's say all you care about is this death benefit, term insurance may be a better choice, actually. Infinite banking is a very complicated strategy if you don't know how to use it. So you're going to be stuck paying someone who does, one of these consultants, a huge sum of money to do it for you. Most people want their finances to be easy, not hard. In my opinion, this product would most likely be good for young, savvy, smart investors who are looking for a place to park money for a future investment or capital need. But this is as long as all of your capital needs are met or can be met in a better way than by selling this policy. If you made it all the way to the end, thank you for watching this video. If you liked it, please click the like button and subscribe to our channel. We would love to keep making videos like this. And please let me know in the comments below if you know of any other ways that this infinite banking strategy could be used. Stay tuned for the next video.